Today I'm going to talk about big guys calculations. I'm going to use some simple figures to illustrate how the big guys play the stock game. Before we start, we have to understand that the stock market is a zero-sum game. Zero-sum means one person wins and another person loses. That is why you have to know your opponents. Your opponents are the big guys. Why? Because they can move the price. You cannot. You accept the price, they move the price. And if the big guys are your opponents, you have to figure out what they will do to affect you. Let's review the big guys strategy again. First of all, they have to employ their lethal weapon. What is their lethal weapon? I've talked about it many times. The big guys' lethal weapons are they have plenty of money to buy and they have plenty of shares to sell. That's why they can move the market. And of course, everybody knows this. You got to buy low and sell high. This is an age-old principle. And if the stock belongs to a very big company, one big guy may not be big enough to handle it, so they have to conspire with other big players to move the stock. Now, first of all, if you want to make money, you have to buy at the very bottom. So, who determined the bottom? You may think that is the market, but what is the market then? The market is just the big guys who come together and they determine what the bottom of the stock should be. So during bad times, they have determined the bottom that this stock should come down to. In that case, they will move in when it reaches the bottom and accumulate as much as possible. So they have a lot of holdings near the bottom. And after that, with this much holding, you can continue to buy up the stock when times are turning good. And then after that, you seduce the small guys, the public, millions of them, to come in and buy, to buy up the stock some more by trumpeting the stocks. How they trumpet the stocks? Well, they employ a lot of analysts to talk good about the stock. And then when the stock reaches a high point, they will determine where is the peak, which is a good peak, so that they can prepare for cashing out. Because if you don't cash out, you don't make any money. And before they cash out, they also have to short sell near the peak, because they know that when they cash out, the stock is going to come down. And if you short sell it, that is a good thing. It's a sure winner, because when the price comes down, you make money from your short sell. They do the short sell to prepare for a price drop. They know that the price will drop because they're going to dump their big holdings. Now they have to do gradual unloading and planning for the bottom. So when you unload, you have to plan where the price should come down. Why do they have to gradually unload? Because if they do it too fast, the price will collapse and they may not get the money's worth of their large holdings. And when the price comes down to near the bottom, they cover the shorts to make additional profits. So in that case, they make profit when the stock goes up. They make profit also when the stock comes down. They may repeat the same process again for the same stock. If opportunities arise, they can move to another stock and play another one. Let me give you some figures by employing a hypothetical mid-sized company to illustrate. Suppose this company, mid-sized company, the price was originally at 30 and it has been driven down to $5. And these are the bottom and the peak determined by the big players. Now it has reached the bottom, it's time to accumulate. A mid-sized company doesn't have too many shares, so their shares outstanding is probably around 200 million. And the average trading daily volume is also not very big. 5 million shares every day trading volume. So in that case, you can see that if a big guy buy or sell about 1 million shares every day, they can move the price. When the price is near the bottom, the big guys starts the process of accumulation. That is, they buy as much as possible near the bottom. In this way, they have succeeded in arresting the decline of the stock. The stock doesn't fall anymore, so it stays around $5, maybe 4 something. And for example, they buy about 20 million shares around this price. The next thing you do is to push up. So after a while, when they decide to push up the stock, let's say day 1, they buy 1 million shares to push the stock up to about $6. And then day 2, they buy another million to push the stock to $7. So let's see how much money they spend. Their total portfolio now is 22 million shares because they bought 20 and then another 2 millions, and at a total cost of about $112 million. How do I arrive at this figure? Very simple. Around $5 per share, you buy 20 million, so it's about 100 million. And on the first day, they buy 1 million shares, pushing it up from $5 to $6. The average price is about 5.5 per share, and it cost them 5.5 million. The next day, they buy another million. Because it moves up from 6 to 7, the average is about 6.5 per share, and it cost them 6.5 million the second day. So you add up all of these, the total comes out to $112 million at cost. Now then, what will happen to the value of the portfolio? Since the price has risen to $7 now, and they are holding 22 million shares now, you multiply by 7, it comes up to 154 million. You compare these two, 154 and 112. That is, the value of their portfolio has gone up by 42 million in just 2 days, because you just compare this one, 154, with 112. The difference is 42 million. And it's worth it because they only spend about 12 million to buy up the stock, and they wind up with a total value gain of 42 million. Now, they might have spent this much money to buy up the stock. They may not have to spend some more because the small guys can see it. When the small guys see the price rise, they will rush in to buy. Further, it will push up the stock. When the stock goes up further and further, the small guys are coming in and the big guys are buying a little bit more. After several months, it's time to think about how to cash out. Now the big guys will come together and determine where should the peak be. Should the peak be around $40 or $50? It's up to them, depending on the economic situation at that time. If they have determined the peak, then they will short the stock near the peak, and then they begin a gradual unloading. Why? I've just talked about you cannot unload it in 1 or 2 days, because if you do that, the price will collapse, and when it collapses, you may not get your money back. So they have to determine the bottom and how and when to reach there. And eventually, when they reach the bottom, they will cover the short sale they have done. So they are making money too on the way down. And if they think that the stock is worth doing it again, then they will come back in to arrest the bottom to repeat the cycle again. So a big company usually has more than 1 billion shares outstanding, and the average daily trading volume is usually over 20 million. So with this large turnover, you need more big players come together, probably 3 or 4. So more than one big player will be involved, and they will play in unison.